Testing, testing. So, can't see if anyone else is here, but I'm gonna talk about some market stuff in the meantime. See if I can share the screen. Okay, so see if I can share the screen. I'm doing more selling than buying lately, but there's some interesting stuff in the market. So some of this company, Life MD, which is kind of like Hims, the company that does the telemedicine, but these are the preferred shares. And what's interesting about this is that they pay almost 10%. And it was more interesting a little while ago when this was at $20. And so you got that kind of double whammy where you would get a much higher dividend and you get a 10% bump on this. But the par on these preferred shares is 25 and they're callable in a few months. So I did own some of the common on this, which I like more than the preferred. And the common went up about 40% a couple of days ago. And I sold too early. I sold when it went up 20% during the day. And then by the end of the day, it went up 40%. And I think that's what made the preferred shares jump up in price as well. And when a company's doing well and they have this very expensive financing with preferred shares, sometimes they like to call it in. And if they call this in, the par on this is $25. So you would get this 9% while you wait, plus a little bit more. And I passed on that because I did like the common, but I didn't want to get the preferred. And I sort of had the opposite feeling with Ammo Inc., where I liked the preferred, but I didn't like the common. So I think LifeMD is a much better company, much better run. And Ammo Inc., I think I wouldn't trust these people to run a hot dog stand, but the preferreds are pretty cheap. So I keep buying it whenever it's like below 21. And as you can see, over the 52-week range, it's gone from $18 to $27. So I kind of use that as a trading sardine where I buy it below 20 and I sell it above 20. But lately, I've been holding on because everything is crashing in the markets. So I feel like it's a pretty good risk reward where you're getting almost 10%. And if these are called at par next year, par for this is $25. And so you would get like another 15% plus this 10, 25% for a year in a market where everything is crashing. I think that seems like a pretty good bet. And as I mentioned, LifeMD, I don't think they're going to call the preferreds because the company's still growing and it's almost making money. But with Ammo Inc., they have Gunbroker, which is the website where they sell guns, and then they have this terrible ammunition business that loses money every year. And they just sold the ammunition business, and they're getting an extra 70 million in cash. So they've got no debt. They've got 25 million in cash already. They're getting another 70 million. What do they need to be paying 10% on this debt? So I think they'll call it next year at par, which would be 25. Get another 15%, and then you get 10% while you wait. And, Life MD, 9% is nothing to sneeze at, but if they call the Life MD shares at par, it's already 24. If they call it at 25, okay, you'll get a little bit, but this is 22. So if they call it, you're going to get more. A couple of things I've been buying lately, Delic and a couple other ones like Venture Global, this is interesting because this was supposed to be a company that went public at $65, I believe. Yeah. And they only sold 10% of the company, but they couldn't go public at 65. And then when it eventually did go public, they were selling 10% of the company, went public at 25, and then looked interesting. And I started buying around 15, and now it's at 8 because of the people in the White House throwing hand grenades at the market. But I think this is a really interesting play because if you compare it to the closest thing that's comparable, which is a company called Cheniere, the symbol is LNG. This is a really interesting play because they make liquefied natural gas and ship it out. So, unlike petroleum, where it's easy to ship out the oil one way or another, natural gas, there's a huge price difference between what it sells for in the US and what it sells for in Europe. It's like 3 or 4 times as expensive in Europe. And the way you transport natural gas is you have to cool it to like a couple of hundred degrees below zero and put it on these special tankers and send it across. So because of that, it's so expensive. We don't have facilities to ship this. Um, this company could be very profitable, and its competitor Cheniere, it took over a decade for them to open up their first plant where they could ship stuff, and this one they have several in the pipeline. And what's interesting about this is, think about if you're building an apartment building, and once the apartment building's done, it's very profitable, but you can't make money until the apartment building's finished. And that's what Cheniere does. So it's profitable shipping natural gas from the US to Europe, but it took a long time to build that apartment building. And what Venture Global does is they have this system where they can build sort of like a mobile home park or individual single family houses, so they don't have to build the whole thing to start operating, and they can just start operating it. And it's a modular system. And as they get more business, just keep building it while they're operating it, and that allows them to be very profitable. Um, so the Trump tariffs and everything else tanked everything in the market, and particularly this. But I think there's a good reason to look at this well too. One of the reasons this got dinged is some of their people that they had contracts with were suing. So they did something which is kind of shady, but not illegal. So they had these contracts and they said, we have to sell you this natural gas at X price when we're operational, when we see our operational certificate. And until then, we can sell it to anyone at any price. And because the price of natural gas went up a lot, they were selling it to people that weren't the people that they had contracts with. And there's lawsuits threatened and everything like that, but I think they'll be fine. So I think what the outcome of the lawsuit is going to be, and I say this as a lawyer and an investor, is I think if Venture Global did anything to delay the receiving those operational certificates, like if they slow walked it or anything like that, yeah, sure, they'd be liable. But if it's just, we're waiting for these permits to get approved and there's nothing we can do, and in the meantime, we're allowed to sell this, then go ahead and sell it. What do you care? And if these guys don't wanna buy it, Societe Generale or somebody else, just sell it to anyone else. I don't think there's a problem with that. So, you guys can feel free to chime in the comments, if you want. And the reason I thought this was interesting and a couple of other companies like, Energy Transfer and EPD is there's, huge tariffs coming on everything imported, including steel. And if there's huge tariffs on everything, including steel, and interest rates are going up, then if you've already built something with steel, you're going to have a huge advantage over your competitors. So these guys have a operational facility, and they've got other ones planned. And the two pipeline companies I mentioned, well, three, Energy Products, Energy Transfer, and Delek, their pipelines are already built. So the steel's already paid for, and they have it locked in at interest rates from before. So if they jack up interest rates and we have another stagflation, God forbid, and you have to pay higher interest and stuff like that to finance new projects, and you're paying more for the steel because of the tariffs, then companies like Venture Global, Delek, EPD, Energy Transfer that have already built their stuff should do really well. And that goes for stuff in shipping too. I have this horrible fetish about shipping where I make money on it, and I know they're terrible businesses, and then I keep investing them, and then I lose money, and then I make money. But when you make money, it's a multi-bagger, so it's very enticing. But if you're looking at shipping companies that have already built ships are going to do a lot better than shipping companies where you have to build new ships, especially if interest rates are going to go up and financing is going to get difficult and stuff. So, that's my opinion on that. But, feel free to chime in if you have any questions. Like I said, I'm doing a lot more selling than buying lately, but I think there's some interesting things, sort of out in the horizon now. Here's another one. Let me pull it up here. So I don't think Crocs is cheap enough because, they're gonna get hit with tariffs, but, oh my god, like, if you were looking at something stupid like Palantir, and then, you look at Crocs and you can, get Crocs at a cheap price, 6 times earnings, that's insane. Uh, and they are gonna get dinged by tariffs if they don't go away because, they're importing stuff, but, this stuff is very easy to make. It's injection molded rubber into these, forms, and at 6 times earnings, oh my god. And, companies like Palantir, nobody knows what they do. There's people at Palantir that don't know what they do, and it's trading at, dozens of times their revenue, not even their profits. So I think, if you're looking at a stupid company like, Tesla or Palantir versus a company like this, it's pretty hard to lose money on this. I don't think it's cheap enough because who knows what's going to happen with tariffs, and I think there's easier wins with the stuff I'm looking at, like the pipeline companies where they're going to give you a nice steady dividend. And the only drawback to those pipeline companies like EPD and ET and Delek, in my opinion, is what it makes your taxes more complicated because they send you a K1, which even if you're using TurboTax, it's a pain in the ass. And I almost didn't invest in them just because I hate those K1s. But um, you know, it is what it is. And here's another company I love. I have medium-sized position in this, Kraken Robotics, and if it went down more, I would buy more. But this is a really interesting, high-growth tech company, and they make batteries for drones, but not drones in the air, like sea drones. And they kind of have this best-in-class operation because uh, other companies that make their own subs buy the batteries from Kraken Robotics because it's like I said, best in class. So what makes it best in class? Under the sea, if you're like laying fiber optic cable or you have an offshore drilling rig or whatever, it's incredible pressure under the sea. And if you send these robot drones down there to do work or to see, what's going on there, you need to keep that battery from getting crushed. And the other companies, they sort of wrap them in titanium to keep them from getting crushed. But that titanium shell takes up space, so there's less room for the battery. And these guys have figured out some tech where it's encased in some fluid. And, like if you have a hydraulic pump for the car or anything like that, that's fluid, and fluid doesn't compress. And so you 30% more energy in their battery than you can in someone else's battery. And obviously, if you are in a offshore drilling rig or something like that, where it's dollars you're losing while it's down, and if you can send the sub down there longer, it's worth paying for. So I think these guys have a great thing. And I bought a little bit at first, and then I just kept adding because it looked pricey to me in the beginning, but they were growing like 40 or 50% a year, and they're still doing well. And so there's lots of cheaper stuff out there, like Crocs at 6 times earnings. But if you can get this at 25 times earnings, and it was growing 50 times earnings, hopefully it'll keep growing. But even if it's not, if it grows at 25 times, uh, uh, if it's at 25 times earnings and it's growing at 25% a year instead of 50% a year, I think that's still a good bet. And if it keeps growing at 50% a year and you're getting it at 25 times earnings, that's even cheaper. So that's an interesting one. And I do have a little bit of Smith and Wesson, and I have several options in it at different prices, like 5, 10, 15. And when Trump started throwing hand grenades at the market, he sort of tank this along with everything else, but I think this is a pretty cheap idea. Let's see, McCoy Global. Uh, what do they do? I'm not familiar with them. Let's see if I can pull it up. McCoy Global. Yeah, I'm not familiar with them. Looks like a small cap company. Uh, oh, so were you guys able to hear me or no? Hmm. Huh, so I don't know what happened to the stream there. Okay. Did you hear anything I said, or was it just all blank? Uh, so I think with the offshore stuff, um, there's a good thing and a bad thing. A lot of these companies, and there's one I'm blanking on the name, but it went through bankruptcy a couple of years ago, and came out with a cleaner balance sheet. You're able to buy it for like a fraction of the replacement cost. So, it's like you're getting pennies on the dollar. But a lot of it is the tech. And so, if you were to scrap these like offshore platforms, you wouldn't get as much as you think you would. Whereas if you're buying shipping companies and they have these old ships, the price you're paying for the stock, it's hard to go wrong because it's a lot less than replacement value. But for replacement values on stuff where you're dealing with high tech is different than replacement values on a ship, which is just metal. Um, so the good thing is that if oil comes back, those offshore platforms, which are the most expensive type of drilling to do, you'll do really well because if somebody else wants to come along and do it, they're going to have to pay a lot more for the tech. The problem is that the stuff doesn't really have big scrap value because it's not just metal like a bulk carrier or ship. It's a lot of tech, which doesn't have a lot of scrap value. And the longer that oil stays depressed, the older the tech is. So, if it was state of the art 10 years ago, if oil takes a couple more years to come back, it might not be state of the art when it comes back. So that's a problem. But there are companies, and I'm not familiar with that McCoy Global, but small companies like that that do service stuff, which can be very profitable. And one of them I just mentioned, Kraken Robotics. So they also have this imaging stuff, like camera stuff, where you can see if there's a hole in the pipeline or anything like that. That's in addition to their batteries, and that should do well if oil comes back and drilling and stuff. And there's another company which I don't own anymore because I couldn't find a lot of info about it, but it's called Mind Technologies, MIND, and they have a similar thing where, except instead of visual stuff like cameras, it's sonar. So there's obviously like military applications and uh, stuff for oil and gas and telecom and stuff like that, deep sea. But they use it's not as clear because you're not using cameras like Cracker Robotics, but it's sonar stuff that's pretty high tech. And it was depressed for a while because they had this preferred shares that were paying a very high dividend. And so whenever they would make some money, it would all go to holders. And what they did recently is they converted the preferred to common, and then all the preferred shareholders sold because they wanted this stock that, and so it was pretty cheap for a while. And it's a micro cap, so I wouldn't buy it with a market order. Like you want to definitely use a limit order. But if you're looking at small companies that are overlooked that could do well in like oil and gas servicing, that's one of them. And if you're looking on land, I hate to recommend, but like land-based drillers are the last ones that go up in a boom and the first ones that go down. So if it starts to go up, uh, it could be a place to go because if everything else goes up, that's usually the last thing to go up. But it's definitely a trading sardine because you want to buy it and then sell it soon. So it's always the last to go up and the first to go down. So land-based drillers, with the rigs, there are a lot of independent companies like Patterson, UTI, and Neighbors, and a few other ones. And the guy from Patterson UCI, I can't remember his name. I think his last name was Patterson, and he said something about the land-based drillers. The problem with them, he said, is if you give them $1, they'll dig you a hole. If you give them another dollar, they'll dig you another hole, and you'll run out of dollars, but they'll never run out of holes. And they did do really well when fracking took off because with fracking, you have to dig a lot of wells, and with a normal well, the decline is sort of nice and slow. But with fracking, you get this big spike in production and then this huge down. So whether you're drilling for oil or even natural gas, you got to drill a lot more wells to get the same amount of production. So these companies like Patterson, UCI, Neighbors did really well for a while. But oil and natural gas is so cheap now that I wouldn't focus there. I think other stuff, oil companies like Occidental go up first, and then if you feel like you missed the boat and there's nothing else that's gone up, then I would look at these land-based oil drillers because they are the last to go up and the first to go down. Some people like the Canadian stuff, like Suncor. I hate that company. And there's a problem with the Canadian oil sands that no one talks about. They have figured out ways to get the price down, and they sort of have this moat because the company that mines the oil sand, they have to have the refinery and everything there. So if you want to do it too, you need to have all those pieces in place. But um, the stuff that they're shoving through those pipes, it's sand covered in oil. And if you think about that, if you have sandpaper and you rub sandpaper on something like metal, it wears away the metal. And so when they're all those pipes, it's like sandpaper and it keeps wearing out the equipment. So the capex on that company is huge. And when oil prices are down, that doesn't matter because that crap is still wearing away the pipes, and you have to keep reinvesting in capex for that. So I don't know. And also we have these tariffs now with the Canadians who this administration thinks are not our friends anymore. So I don't know what to do with that. But I think there's easier ways to make money. And the ones that I was looking at recently, Delek and EPD and ET, they're sort of like toll booth businesses because whether the price of natural gas or petroleum is high or low, you still have to send it through that pipe and they get their cut. And it's not a huge amount, but things like the pipelines, the refineries, and everything else where you're sort of getting a cut of the action, whether it's going up or down. I think those are safer places to be, especially if the price of steel and everything because of tariffs and higher interest rates is going to go up. Then people that have stuff in place, it's going to be more attractive. And there's lots of people. I used to own some refineries like PBF and Phillips, and I don't anymore because it's you have to time them right. People love refineries, and they love to say that what, there's not been a refinery built in the U.S. since the '70s, so you're pretty safe if you own a refinery, and that's nonsense. There are at least a dozen built since the 1970s. I don't know who keeps spreading this lie, but it's not true. And I worked to tell you, there have been about a dozen built, but they are small, specialized ones. So, like, if you go to the back end and all these places, like, they have these small refineries that are used for specialized productions, like petrochemicals and stuff like that. So it hasn't been a huge refinery built since the 70s. That's true, but they do build them. And if you think you're safe. Well, they haven't built a huge new refinery in the US, but they built a new one in China. I think they built one in Saudi Arabia, huge new ones. So, it's always check when somebody tells you something ridiculous, like, there hasn't been a refinery built since the 1970s. Just Google that and you'll see it's complete nonsense that Jim Cramer or somebody else is spreading. Let's see. I think we will be friends with Canada again. Start a small position, ADF Group and Algoma Steel. Is ADF the payment processor? No, that's ADP. Okay, I'm not familiar with either of those, but I might check them out. Yeah, so commodity companies, it's tough to do. They have to be trading sardines because if you're the low cost provider, you do great, and then otherwise, it's tough to do. And there's this weird thing with operating leverage where um, if you're the low cost survivor, you'll survive any downturn. But when things go up, you wanna be in the worst company, not the best company, and that sounds like it doesn't make any sense, but, picture a bunch of different companies. I have one, you have one, we all have one, and then we all sell something for, $10, and, it costs you $9, and it costs me $1, right? So if prices go down and you guys start going out of business, I only charge a dollar. It only costs me $1 and I can sell it for 9. I can always undercut you guys and I'll be the last man standing. But if things go up a lot, let's say instead of $10, whatever you're making, you can sell it for $11 now. You want to be in the worst company possible, which sounds terrible. But if I make it for a dollar and I sell it for 10, and now I can sell it for 11, I was making $9 before, and now I'm making 10, so, I'm making 10% more. But if you're making it for $9 and you're selling it for 10, and now you can sell it for 11, instead of making $1, you're making $2. So you're a terrible company, but your profit doubled. So, yeah, so oil companies, things like that in a downturn, you wanna be with the low cost provider, and when things turn around, you wanna be in the worst company you can find 'cause, those are ones that you tend to make the most money. And, uh, not an opinion on Vitesse, which I used to own, but I don't have them anymore, but, Occidental is really interesting because they don't hedge most of their production. So some companies like, uh Vermilion, which does natural gas, they hedge most of their production, like half to three-quarters of their production. And so, if things go down, they'll survive. And if things go up a lot, you'll make a little more, but not that much more. But Occidental, I can't remember if it's like 25 or yeah, like 25% of their production is hedged or 30%, some very low number. So they're really hurting now because oil is down and, but if things go back up, they're gonna do really well because they haven't hedged their production. So, and yeah, that's my thought on, that. What else am I missing? Nintendo's doing really well, and I'm glad I haven't sold much of it. So, uh, I started buying over a year ago, and I think I did a couple of videos on it where it was like, $12 or $13, and it's like 21 or 22 today. And this sort of, last piece of the puzzle was, will the new console do well? And people were saying it's overpriced. People are saying, tariffs, this and that. But when they released it for pre-order, it sold out in Japan. Like all the people that pre-ordered it can't get it. So it's already sold out in Japan and a couple of other places, and hasn't even hit the U.S. yet. And I think it's got sort of this uh, self-reinforcing loop that I like, where um, the if you buy a Nintendo Switch, you're more likely to use Nintendo Online, and if you have Nintendo Online, you'll buy more games. It's sort of like a cloud-based thing, and, there's a live action movie coming out next year, and there's some theme parks that are being built where they don't pay the money. So Universal, the one who makes, Universal Studios, is building, 3 or 4 of these theme parks, and Nintendo doesn't put up any money, but they get 6% of the gate, which doesn't sound like a lot, but, if the Switch and these video games and everything else do well, then the theme parks will do well, and it can sort of become like the next Disney. And if it doesn't do well, you didn't put up any money for those theme parks, so you're fine. So I think that's gonna do really well, and, I haven't sold. I think I'm up like 60% on that in a year, so, and I don't wanna pat myself on the back too much because some of the stuff I have, like, St. Joe is down a lot and Occidental, but there's another company that I own a lot of, and, I sold some exactly 30 days ago, to lock in some tax losses, and I was gonna buy it back after 30 days, so of course it went up in between those 30 days, but there's a company called Coupang, which is like, the Amazon of South Korea, and I did a few videos on it, and it's worth checking out, but they are better at what Amazon does than Amazon is. So, Amazon pisses me off sometimes because they'll tell me it's 2 days. ended up being 3 days and sometimes longer. But with Coupang, they have operations in Korea and now in Taiwan. And in Korea with Coupang, if you order it by midnight, if you order before midnight, it will be on your door by 7 a.m. And it's an incredible company. And other competitors like Alibaba and other stuff haven't been able to make inroads into Korea because they're so well entrenched there. And the only competitor that's even close, and it's kind of different. I think they're going to lose. There's a company called Naver, which is sort of a combination between Google and Shopify. So if you're a company and you don't want to go through Coupang, you can sort of list the product yourself on Naver and you deliver it, not Coupang. But customers sort of they don't want that. They want to know if I'm going to order it, I'm going to get it by 7 a.m. Not that some delivery guy I don't know might come, might not come, and what's your return policy and this and that. So I think in the long run, Coupang is going to do well. And I think the only thing that'll derail it is if this trade nonsense keeps going and there's a global recession, and then Korean consumers or Taiwanese consumers are hurt by this. But Korea is doing really well, and then they expanded to Taiwan, and Taiwan is actually growing faster than Korea did. So it's very promising there. And obviously, Taiwan's a little risky because the Chinese always want to invade, and Taiwanese don't want to be part of Taiwan, part of China. I have a friend who's Taiwanese, and if you ever say she's Chinese, she'll correct you because, yeah, it's like Canadians and Americans, like they don't want to be part of the U.S., and I don't think an invasion will help that. And so that's the only risk with Coupang. And but Coupang also has this thing that some companies like Google and Apple have, where they have a negative cost of capital, so it literally costs them nothing to grow or less than nothing. And why is that? It's because they sell stuff on their platform so fast that they pay their suppliers in 90 days and then they sell it in 30 days. So they have this free money for 2 months. And, you know, as they keep selling more and more, that pile of free money keeps getting bigger and bigger. And, you know, if they did nothing with it, it would be free, but, you can leave it in the bank, you can finance your expansion, so their cost of capital is negative, where other people would have to borrow money from the bank and pay 10% to grow or whatever. With this company, as long as they keep growing, that pile of money keeps getting bigger, and it makes it harder and harder to compete with them all the time. So, that's a really interesting one. And then, Fairfax and Berkshire are have been doing really well lately, and I have positions in both. So some of the other big companies have been getting killed, but it seems like companies that have a lot of cash on their balance sheet, like those guys, the market is rewarding that because it sort of gives you optionality. And Berkshire Hathaway, Buffett tends to strike really good deals when things aren't going well. And Fairfax, it's FRFHF. He's known as the Canadian Warren Buffett. He's got his own insurance company and also is a really well-known value investor. But people are less willing to give him a chance than he sort of sticks to traditional value investing and invest in things that Fit won't touch anymore, like steel mills and coal, uh, really terrible businesses like that. But he does really well at it. So if it works, keep doing it. But yeah, so I have Berkshire. I think now that Google has crashed like 20 or 30%, now Berkshire is my biggest position. It used to be Google. I haven't sold any, but it's just the way Berkshire's gone up and Google's gone down. And I think now my second biggest one is Fairfax, followed by St. Joe, which is taking a pounding also. But I think long term, St. Joe, you'll do fine because they have 180,000 acres of beachfront real estate. And if you convert that to acres, I want to say New York is like 300 and sorry, square miles. I want to say New York is like 300 square miles. And if you take out the East River and the Hudson and all the water, because you can't build on the water, you have like 300 acres in New York City. And St. Joe, I think, is like 250. Don't quote me on that, but it's a little bit smaller than all of New York City, and it's on the Florida Panhandle. And even if the economy suffers, they are doing really well. and over time, that stuff's going to get more and more valuable because they donated land for the new airport because the old airport uh, couldn't grow anymore. So they donated new land. They got this tax deduction for that for the donation, and they own all the land around the airport. So if you want to build a Hertz, if you want to build a hotel, anything like that, you have to go through them. So they've done a really good job with that, and I think long term they'll be doing well. There's one that I have a lot of that sort of struggling now, and I'm on the fence about. It's called FRPH. It used to be Florida Rock, and they have a lot of stuff in DC, which I can go take a look at. But I think with the government laying off people and everything like that, it's sort of exposed to DC because they own a lot of stuff in DC, and they have other stuff which is really interesting in Florida. They went back when they were Florida Rock. They sold most of their stuff to a company called Vulcan, which does like aggregate and stuff like that. But they have a couple of limestone and stuff like that mines in Florida that they're leasing out, and so they get this regular payment every year. Florida Rock does, FRPH. And what's interesting is that it's near very valuable land in Tampa. And this company is digging out mining, and then when they give it back to FRPH, it's going to be lakefront property because if you dug out this stuff and it rains, the water fills it up, and other developers who have to make these man-made lakes because it makes the land more valuable. Somebody else is making it more valuable for them. They're giving the money for it, and then they'll get it back in 2026 and 2027, and it'll be worth who knows, like 100, 200 million more. And the risk is they do have other stuff like warehouses and apartments and stuff like that in Washington, D.C., which is very exposed to the nuttiness in the White House now, where they're trying to hurt federal employees and fire everyone. So, uh, you know, people that rent those buildings, businesses that restaurants that service the people that live in those buildings. Uh, that's an exposure. So it's risky, but you're getting it for a cheap enough price, and there's huge insider ownership. So I feel okay with that one. There was another one that I used to own that I sold recently. It's called DEA, and it's Easterly Government Properties. And there's two companies that you can sort of bet on the landlord, and one is a postal REIT. I forget the name, but uh, I think it's a terribly run company. And DEA was really well run, and it paid a nice dividend. And but with the government trying to cancel all their leases and stuff like that, I felt like um, it was easier just to do something else, especially since I left my job, and I don't have a steady paycheck come every 2 weeks, so I'm a little more risk averse now. But DEA, the price got cut a lot recently, and it's cheaping up that if I was more risk tolerant, I would take a look at it again because uh, I don't think this nuttiness is going to continue forever. So if you want to check that one out, it's called DEA, and it's interesting because it's a REIT, and a lot of the closures of government buildings and stuff like that probably won't affect them as much because VA hospitals and things like that are very difficult to close. And if you want to like get out your pen and figure out which ones are vulnerable or not, I think it'll look all right. But is there any questions you guys have? Things you're looking at? Oh, I was gonna mention, Smith& and Wesson. So, I think I got cut off when the the feed went blank, but Smith& and Wesson, it got cheap, and I've traded it before. I think I made like 50% in 1 year, and then I sold out of it completely, and then the price tanked. So, I think I was buying it like 10 or 12, and then it went up to like 16 or 17, and I sold it. Now it's back down below 10. And I don't have many shares, but I have some options on it. So I think if you get go 2 years out, the options are pretty cheap, and I think it will come back, especially because uh, it tends to do better um, in rough times. And with guns, there's this weird thing. It's kind of like cars. Like, if you only make a few guns or you only make a few cars, it's hard to be profitable. But, if you have the tooling equipment and you make a few that pays for it, and then each additional one is very profitable, and they have really profitable models like the Bodyguard and these folding pistol carbines and these new lever action cowboy style guns that sell for like $2,000. It is really profitable, and their only other publicly traded competitor is uh, Ruger, and Ruger sort of makes more like Honda Civic type guns where they're like uh, sturdy but not fancy, and Smith and Wesson is a higher. People will be willing to pay more, and so especially at these prices where a lot of what was holding the stock back is we're spent like 120 million on capex because they built a new factory in headquarters in Tennessee. So they moved from Massachusetts, which was not very kind to them, to Tennessee, and it's a lower tax state, lower cost state. So you can hire workers there for 30% less than you can in Massachusetts. And they have all that capex, 120 million was kind of holding it back, but now that that's all paid for, all the money coming in, they can use that to buy back shares or for the dividends. So I think from here forward, it looks a lot better than it did before. And I'm glad I sold at 17, but I do have some, like I said, options. And the price is pretty cheap now. And if I was more risk tolerant, I would buy more of the common. But I figure, okay, if I buy, it's at like nine something, 950 today, I think it was. And if I buy an option at 10, right, then it's got 2 years to get to that price. And if you buy an out of the money option, so like instead of the strike price at 10, let's say I buy it where it's in the money and the strike price is 5, right? If I bought 100 shares, I'd have to put up $1,000. But if you buy an option and the strike price is 5, and they're charging you like uh, 510, right? So you're paying a little more, but you're able to control 100 shares for 2 years for half of what you'd be able to buy the common. And if you think it's going to come back within 2 years, that's a good idea. If not, eh. But the fact that it pays a 5% dividend at this price is part of the reason why you're getting the option so cheap, because if you bought the shares, even if it went nowhere, you'd get 5% a year. So the person who's selling you the option, they're getting that 5%. So they're willing to sell you the shares cheaper. And if you just want the income from that, it's probably a wash. But if you think it's going to go up and you find these companies that are paying a decent dividend, the options are probably, if you buy them in the money, cheaper than you can get um, buying the common shares and just holding them for a couple of years. So that's one to think about is Smith and Wesson. Let's see what else. Scorpio tankers, I sold some. I still think it's too cheap, but uh, that company benefits from disruption. Like if there's attacks in the Middle East and you have to reroute ships away from the Suez Canal and stuff like that. But they do transport gasoline and everything. So if there's a recession, I don't know that it'll do as well. Let's see. American Eagle, could be. I haven't looked at them. What's your view on Tesla? I think it's a terrible idea. And I know people hate when I get hate comments when I say don't buy Tesla. And it's not just a political thing. Part of it is political. He's ruined the brand. He's ruined the company. Most of the people who buy Teslas are Democrats, and you're doing everything, doing Nazi salutes, firing federal workers, doing horrible things. He just damaged the brand irreparably. The Cybertruck was horrible. Um, you know, they've all been recalled. He thought he was going to sell 250,000 Tesla trucks, and he reduced that to 25,000. And now they've all been recalled because, in his quest for efficiency, he thought it was more efficient to glue the panels on than to screw them on. And they've been falling off the trucks. And I think if you wanted to buy a Cybertruck, like why would you even buy the truck? Just pick up all the pieces that fall off by the side of the road, and eventually you have enough pieces to make your own truck. But if you look at what it's trading at, even though it's down 50% from where it was, it is still more expensive than all the other car companies combined. And, I think that valuation is ridiculous. And a lot of it is based on hype about self-driving cars and robots and everything like that, which, if you sort of take a step back, you realize it's not plausible. So, he's been promising full self-driving for a decade, and every year he says it's going to be next year, and it never happens. And if he thinks he's going to do better than Waymo, that's kind of silly because Waymo already has fully autonomous taxis in many cities, and they've been doing it for uh, at least a few years in Arizona. I have my sister-in-law lives in Arizona, and they've been doing it for years there, and now they're doing it in California and a bunch of other cities. So Waymo already has full self-driving, and Tesla doesn't, and they keep promising it's next year, and it's not. And if you look at the two most important things to measure self-driving by, which is total number of miles and the number of miles you go before you have to grab the wheel because something went wrong. Waymo is number one on both those. So, and it's owned by Google. So that's something to consider. I think Google's a great company. Based on those two metrics, Tesla's like number seven. So that's completely unrealistic that they think they're going to displace Waymo. And also the robot thing, you know, it was a mechanical Turk. People were seeing these robots, but they're being controlled by people, in the other room, making it say what they want to say. And if you think that he's going to sell uh, these robots for $30,000, and there's a lot less tech that goes into a truck than goes into a robot. And we've been making cars and trucks for 100 years. And if you sell the truck for 100,000 and there's a lot more tech in the robot, and you think you can sell the robot for 30, I don't see how that's possible. But what do I know? And so I think, if you look at his other things like the Boring Company, there's a thing where you can ride on a car in the Boring Company in Las Vegas and it goes 30 miles an hour. So it's like the highway, but worse. I just think if you look at the valuation and compare it to any other car company, it's ridiculous. Uh, the Tesla cars were getting lower in price, and if you look at a car company with the highest margins, that would be Ferrari. Um, and if you're selling lower price cars like Hondas, the margin on those is lower. So, I don't think selling mass market cars there's any way to make the margin higher. So, you're kind of trapped there. And they've sort of been saved because of there's actually 100% tariff even before Trump got in office on Chinese EV vehicles because they were accused of dumping. But if BYD sold their cars here, even with the 100% tariff, it would still be cheaper than a Tesla. And the BYD cars are better than the Tesla cars because they can go a longer distance without recharging. They recharge faster, and they have a whole bunch of other benefits. And they're half the price. They're like less than half the price. So BYD isn't here yet, but Tuan Wan Fun is like literally like Thomas Edison, and he's gonna knock Elon out of the water. And I would stay the hell away from Tesla, unless you like gambling. That's just my opinion. But I don't think there's any way that you can slice it and dice it, and it looks like something that would be worth more a year from now or 2 years from now than it's worth today. Uh, and there are, the solar stuff that he's been promising for decades. Like now they're cutting solar subsidies and stuff like that, and that was a huge part of their profit is subsidies from solar. And Tesla made a lot because they were selling these green energy credits to other companies like that do a lot of polluting, so they need to buy these green energy credits. And if you're cutting that back on those green energy credits, and that was like a huge part of Tesla's only profits, then that's kind of uh, another nail in the coffin. So, uh, do I look from filings from investors? Yeah, on Dataroma, you can see a lot of value investors, and their monthly filing out on May 15th because they're due they're due after the quarter 5 days after that to do the filing. So the ones that are due in December, everybody puts them out like February 15th, Warren Buffett, Prem Watson, whatever. And the ones that are due in March 30th, tend to come out on May 15th. So you can go to Dataroma and look at the filings and see who's buying what and what they're selling. And there's another website which is pretty good. I'll see if I can share the screen, and then I'm going to cut off in a second. But it is called SEC Form 4 Insider. Let me see if I can open one up here, and I'll share the screen, and you guys can see. And this is buying and selling of and this is a good way to find sometimes like unfollowed companies and small cap companies and whatever. So here on the top one, it says cluster buys, and that's where people buying a lot. So like here, Blackstone, somebody there bought 25 million, and then below that, you've got insider buys, FTI Aviation, Codexis, Eagle Capital Growth. I don't know what those are, but you can look at them and figure that out if it looks interesting. And then if you go down here, this is where it's really interesting. Uh, Insider sales and penny stock insider buys. And Tesla caught my eye here because Elon's brother sold like 25 million in a few days. And Elon's begging people to buy more Tesla stock, but his brother's dumping it, as fast as he can. But if you look at these companies, Archer Aviation, that's one that makes what they think will be commuter helicopters. So instead of taxis, you can take a helicopter to work. I think it's crazy, but people invest in it. But you can see this guy's an insider, and he's selling 500,000. Like, is that something you should be concerned about? I don't know. Uh, Vistra, I think that's an energy company. So that's that. And then here, penny insider buys. So it's sometimes you'll find here something you've never heard of, but it's a small company. But if insiders are buying, it might be worth taking a look at. So they're usually companies that are too small for a big investor to take a position in because they're penny stocks. But if you see insiders buying, might be a good place to start digging. So I don't know this one, Martin Midstream Partnerships LP, but that sounds like one of those companies like EPD or ET that does those drop down things with the K1. So that might be worth checking out because this guy bought some Codexis. I don't know what that is, but look, another insider buy from Martin Midstream. So that might be worth checking out. Flex Shopper, I don't know what that is. Let's see. Orchestra Biomed Holdings. I don't know what that is, but let's see. Martin Midstream. So if I click on that, and again, this is form4insider.com, you'll see that looks like there's been a lot of insider purchases recently. So 30,000, 200,000, 213. And if this was a big company, I would say like, oh, come on, that's nothing. That's chump change. But on these small microcap companies, if you see the CFO, the president, the director buying lots of this, it would be something to think about. I wouldn't say buy it just based on that, but if they don't have to buy and they are buying, why is that? And if you see a lot of them buying, not just one guy who's delusional and really believes in his company, if you see several people buying it, that could be something interesting to think about. Uh, uh, okay, so I think that's it for the day. Thanks for tuning in, and like and subscribe to the channel because I don't usually do these, but I just figured I'd jump on today. Enjoy your weekend, everyone.